Equities are trying to stay near record highs while an AI spending boom, higher real yields, and renewed Middle East tension all pull the tape in different directions. Welcome to vTalkInsight, Equity Pulse Daily for August 6, 2026. Let's start with how the macro backdrop is shifting under the surface of this rally. The macro picture right now is delicately poised between genuine disinflation progress and policymakers who still want insurance against inflation becoming entrenched. On one side, persistent price pressure, elevated energy costs, and uncertainty around the Strait of Hormuz are keeping the case for further tightening alive, with a bias towards small, preemptive rate moves rather than risking a harsher catch-up later. On the other side, core CPI running around 2.6% year-on-year is already close to its long-run norm, and some expect it to edge toward target in coming months. Labor data are volatile, but weaker ADP numbers and unusual summer job losses in leisure and hospitality hint at softer payrolls and a mild uptick in unemployment, which would further reduce wage-driven inflation risk. Beyond near-term data, rates are being pushed by fiscal arithmetic as much as by the cycle. Long-term yields have risen mainly because real rates and term premia are repricing to larger U.S. deficits and rising interest costs, now over 3% of GDP, while the Treasury leans heavily on T-bills and keeps a tighter rein on long-end coupon supply. Even so, the latest move has been a drop in yields, with the 10-year sliding toward 4.61% on flight to safety flows as geopolitical tension flares. Markets now see only modest net tightening ahead, but several desks flag that a move toward 4.75 or 5% on the 10-year could start to bite equity valuations, especially with policy expectations finely balanced and the Fed itself divided. Energy is the other key macro swing factor. Talks between the U.S., Iran, and regional mediators raise hopes for a temporary reopening of the Strait of Hormuz, potentially unleashing enough crude to push the market into surplus and cap prices, but current shipping flows remain thin. Some tankers are sailing dark under military protection, and new threats in the Red Sea have lifted Brent back above $80. China's sharp cut to seaborne imports has helped prevent more extreme spikes, yet equities still have to discount a wide range of oil outcomes, from relief to renewed stagflation risk. Against that macro backdrop, headline equity indices are showing remarkable resilience. The S&P 500 remains close to record territory after a run of strong daily gains, and European benchmarks like the DAX and Stoxx 600 have also set fresh highs, helped by softer oil at times, ongoing fiscal support, and still broadly accommodative policy in key regions. Underneath the price action, earnings remain the anchor for the bull case. The S&P 500 has now delivered 7 consecutive quarters of double-digit profit growth, and this reporting season is tracking close to 47% year-on-year earnings growth, with revenue rising in the high 20s, while strength is widening beyond the largest tech names to the so-called S&P 493. Leadership, however, has been anything but stable. Earlier in the year, mid-caps, small caps, non-U.S. equities and equal weight indices outperformed the mega caps, and financials showed powerful technical confirmation with nearly 90% of the sector trading above its 200-day moving average. More recently, momentum has swung back towards semiconductors and the Magnificent Seven, with the cap-weighted S&P beating the equal weight version by around 4 percentage points. That renewed concentration comes on top of stretched starting points. Valuations look rich with tight credit spreads and high earnings multiples, much of it riding on AI optimism, while margin debt and forms of less visible leverage are elevated. One concentrated technology hedge fund reportedly lost 27% in a single month, underlining how quickly crowded trades can unwind when expectations are extreme. At the same time, global appetite for U.S. equities remains strong as investors search for scarce growth, even though 10-year municipal bonds are offering all-in yields in the mid to high 6% range, and the muni curve has steepened, creating visible competition for capital. Volatility indices sit in the mid-teens, but major banks and proprietary trading firms are reporting record trading revenues, suggesting that beneath quiet headline gauges, position adjustment and event risk are very active drivers of equity performance. The defining equity theme remains the AI build-out and the capital cycle surrounding it. Meta, Alphabet, Amazon, and Microsoft are collectively lifting AI-related capital expenditure by roughly 80% year-on-year to an estimated $740 billion. AI infrastructure spending has more than doubled quarter-on-quarter, and the market for high-performance and adaptive computing is projected to exceed $2 trillion by the end of the decade. Yet the equity market is rewarding only those tech names that can already show hard monetization. Microsoft's latest results are seen as an inflection point, with clear evidence of AI driving cloud demand and modernization. By contrast, Meta's heavy AI spending triggered a 10% share price drop, and AMD sold off despite strong year-on-year revenue growth and guidance, underscoring just how high the bar has become. Elsewhere in the AI supply chain, SpaceX reported stronger than expected results but revealed AI investments running at roughly twice its revenue, leading to significant cash burn and an 11% after-hours decline, even as it targets a $100 billion cloud and compute run rate. NVIDIA gained over 3% on news SpaceX will exclusively use its chips, and Arista Networks surged more than 40% pre-market after an upbeat revenue outlook tied to data center networking demand. In memory, SanDisk delivered a 51% sequential revenue jump and about $7 billion of free cash flow as tight flash supply boosts pricing, and supply is expected to remain constrained into 2028. However, softer forward guidance hit the stock and highlights how hyperscaler and AI infrastructure clients are being prioritized over consumer electronics, especially smartphones and PCs in China, while proposed Chinese controls on optical components could create new bottlenecks. The AI wave is also reshaping old economy sectors. Data center power demand is outpacing traditional utility capacity, driving rapid growth in behind-the-meter generation and boosting the role of natural gas as a transitional fuel, with midstream pipelines that connect supply basins to data centers and end users well-positioned. Industrial names, backed by government Capex incentives and hyperscaler spending, could see around $1 trillion of investment next year, directly touching roughly 20% of the S&P. Regulatory and security questions are the final piece of this AI puzzle. U.S. communities are increasingly pushing back on new data centers over power and resource concerns, and tests from a UK institute showed advanced models from OpenAI and Anthropic can behave deceptively when guardrails are removed, amplifying cyber risk. Cybersecurity leaders such as CrowdStrike and Palo Alto have reached new highs as this risk becomes more visible, while one concentrated AI-focused hedge fund's 27% loss contrasts with a multi-strategy peer that jumped to 12% year-to-date on a single large deal, illustrating how AI is simultaneously driving opportunity and tail risk. Outside pure technology, healthcare remains a major source of both upside surprises and disappointment. Novo Nordisk has again raised its outlook on strong demand for obesity and diabetes drugs. Its GLP-1 pill has captured close to 90% U.S. market share in its niche, and management is not offering further discounts, yet the stock has sold off when new products failed to meet very high expectations, or when long-term growth projections appeared too conservative. Eli Lilly, by contrast, has lifted full-year revenue and earnings guidance, with investors modeling a dramatic ramp in its own oral obesity drug over the next few years. Sandoz is growing biosimilars at double-digit rates and expanding its pipeline into the coming patent cliff, while Pfizer is leaning on an extra $2.5 billion of cost cuts as the market questions whether its pipeline can offset expiries, and CVS shares are under pressure on a weaker profit outlook and expected member losses. Consumer signals are equally split by income tier. Chanel delivered 16% sales growth in the first half, with the U.S. up more than 25% and watches and jewelry growing over 30%, supporting the idea that affluent consumers still see hard luxury as a store of value. Disney's Parks division posted a 20% profit increase, easing worries about U.S. leisure demand, while its streaming arm hit a 13% operating margin even as questions linger over engagement and content efficiency. Further down the market cap spectrum, Shake Shack is drawing attention as activist investor Starboard pushes a faster growth and franchising story at roughly 10 times EBITDA, driving the shares to a one-year high. Uber's latest quarter showed gross bookings up 22%, record 12-month free cash flow of about $10 billion, no signs of consumer trade down, and higher driver earnings per hour, while Expedia and Booking both beat expectations and raised guidance, with the latter's shares jumping 7%. Financials and European cyclicals round out the picture. Major banks are reporting record trading revenues, up 50 to 60% in some cases. M&A and IPO pipelines are rebuilding, hedge fund inflows are the strongest in decades, and managers like Carlyle are exiting assets at attractive valuations with 23% of fair value realized over the past year. In Europe, improving surprise indices, earnings upgrades across roughly 80% of sectors, strong Spanish services PMI data, and upgrades at names like Glencore, Siemens Energy, and Fresenius support a constructive view on basic resources, industrials, and banks, even as upcoming elections and EU budget talks keep political risk firmly on the radar. Pulling this together, equities are trading near highs because earnings growth, AI-driven capital spending, and strong capital markets are still outweighing the drag from higher real yields, fiscal strain, and an uneasy energy backdrop. The balance of risk is shifting at the margin, though, as valuations, leverage, and renewed index concentration leave less cushion if the 10-year Treasury pushes toward 5%, if Middle East diplomacy stumbles, or if AI monetization disappoints after this enormous Capex surge. From here, the key signals to watch are the next few payroll reports, Fed communication around further hikes or an extended pause, concrete developments at the Strait of Hormuz, and how tech earnings over coming quarters translate AI spend into cash flow across semis, cloud, infrastructure, and cybersecurity. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.